Good afternoon. I want to welcome everyone to a very important moment on the arc of our progress as we come together today. And I want to thank Chairman Bernanke for agreeing to come and talk to us today about our work and his perspective on our work. I am, for those of you who don't know me, I'm Mark Pinsky. I'm President and CEO of Opportunity Finance Network, and I am pleased to be here with all of you. To introduce the chairman today, I want to introduce Ned Gramlich, who is a newcomer to our board of directors, and he has a little experience serving on boards. From 1997 to 2005, he was a governor on the board of the Federal Reserve. He is currently a senior fellow at the Urban Institute, spent a year as the provost at the University of Michigan, which sounds like about one of the tougher jobs, Ned, and has a long history at the University of Michigan as Dean of Public Policy. He led the economics department. He has a long history of research and policy work, of government service. And I ask you to please join me in welcoming Ned Gramlich.
Thank you very much, Mark. I asked Mark to make it brief because you didn't come to hear me today. You came to hear my good friend and former colleague, Ben Bernanke. Ben grew up in Dillon, South Carolina. His grandparents moved there in the 1940s, and first his grandfather and then his father ran the local drugstore. As far as I can tell, in extensive research in Google, Ben never did run the drugstore, but he does report spending a lot of time in the comic book section of the drugstore. Ben was an outstanding student in Dillon, and when he's in 6th grade, he was the spelling bee champion and won the South Carolina tournament and then went to the Nationals. And again, this is on Google, but there is a little, some things in here that you won't find on Google, so I'm going to tell you. He went to the Nationals, and as I understand it, if he had made it through that, he would have been on Ed Sullivan. He lost on the word Edelweiss. And, I did the numbers, and this was the mid-'60s when all of this happened, and at the time Sound of Music was out there. So how could he have lost on the word Edelweiss? Well, it turns out Dillon didn't have any movie theaters, so he started off a little behind, but he has since caught up. He went on to Harvard, and then got his PhD at MIT. His first job was at Stanford, and then he moved on to Princeton. He came to the board in year 2002, and at that time he was the Howard Harrison and Gabrielle Snyder Professor of Economics and Public Policy at Princeton. He was Professor of Public Policy, but again, Google says that his only public policy position until that time was as a member of the Montgomery Township Board of Education. So to go from that to the Federal Reserve was a very big step indeed. When Ben came on the board, I was chair of the Consumer and Community Affairs Committee, and by normal standards, I am a political moderate, but by Federal Reserve standards, I was a screaming liberal. And the person who set up the committee assignments, Roger Ferguson, was very worried that my committee would bring a series of commie-type regulations before the board. So Roger set up the committee with me as chair, and Ben was on it. He was a Republican appointee, and Sue Bies, who was also a Republican appointee and also a banker. And Roger told me, well, if you can get them to agree on anything, we'll consider it. Well, we did go through a lot of things. We went through community reinvestment. We went through HOPA. We went through HMDA. Fair Credit Reporting Act, TILA. There was a whole string of things. And really, the committee never had any significant disagreement at all. Indeed, on Reg B, which is another issue we had, Ben was the one who came up with the magic compromise that got everybody aboard. So I learned that he was a strong proponent of open capital markets that were open to people of low income, that he is a strong supporter of equality of opportunity, of efficient capital markets where borrowers do not operate in an information disadvantages compared to lenders, and all of those things. And most of the board's regulations at that time were designed to promoting those goals. The modern era of the Fed starts in 1951 with the Accord of the Treasury. There have been 6 Federal Reserve chairs since that time: William McChesney Martin, Arthur Burns, William Miller, Paul Volcker, Alan Greenspan, and Al Ben. Several of these earlier names are already in the Monetary Policy Hall of Fame. There is one who will surely go in when the obligatory 5-year waiting period is over. And I fully expect that when the time comes that Ben will be there too. He has very solid understanding of the economy, of monetary policy, of the way markets work. He's already introduced some innovations in the way the Open Market Committee operates, and I expect there to be more. And he's going to be a big champion of low-income lending. So I give you Ben Bernanke.
Thank you, Ned, I think, for that introduction. Thank you. Nice to see you, Mark. And we did actually get a movie theater in Dillon after a while. And I recall my father calling him up and saying, well, what time does the show start? And they said, well, what time can you get here? Well, I'm very pleased to have the chance to speak to your conference. Since I assumed my new responsibilities earlier this year, as well as during my earlier stint as a member of the Board of Governors of the Federal Reserve, I've met on numerous occasions with community development leaders to discuss both their achievements and the challenges that they face. In visiting some underserved communities, I've also seen firsthand the effect of various development initiatives. I've also regularly attended the meetings of the board's Consumer Advisory Council, just met a couple days ago, which brings together community representatives and lenders to discuss a range of consumer and community development issues. These experiences have helped me appreciate the many ways that community development financial institutions, which I use the familiar abbreviation CDFIs, have been working to strengthen communities and improve the lives of lower-income people. Ensuring that every American has a chance to improve his or her economic circumstances through hard work, saving, entrepreneurship, and other productive activities is essential for building healthy communities and achieving sustainable economic growth. The Federal Reserve and the CDFI community share a common interest in increasing economic opportunity for all Americans. The Federal Reserve supports local economic development, for example, through its active engagement in financial literacy programs, through its community outreach efforts, through aspects of its role in regulating banking and financial markets, and by its research in regional economics. But the Fed's central mission to help maintain a financial and macroeconomic environment that fosters price stability and maximum sustainable employment is of necessity focused on the economic performance of the nation as a whole. Monetary policy is a blunt tool that cannot target industries, population groups, or regions. In contrast, as you know, CDFIs operate primarily at the microeconomic level, community by community. Using techniques such as financial counseling, local market research, and specialized lending, CDFIs work with partners in both the public and private sectors to help unlock the economic potential of lower income and underserved communities. The theme of my remarks today is our shared goal of increasing economic opportunity. I'll first discuss some of the progress that has been made in recent years in the economic situations of lower income households and communities, as well as some of the important challenges that remain. I will then offer my perspective on how CDFIs and their partners can help to meet those challenges. In the past decade or so, U.S. households overall have experienced notable gains in terms of some key indicators of economic opportunity. Three such indicators that I will briefly discuss are access to credit, rates of home ownership, and small business development. Moreover, as measured by these indicators, recent improvements in traditionally underserved markets appear to have been as great or greater than those in middle and upper income households and communities. At the same time, however, the gaps between lower income households and other households with respect to these measures of opportunity remain wide. Access to credit is an important element of economic opportunity and community economic development. It supports home ownership and small business creation and provides greater financial flexibility for households. In recent years, advances in information and communication technologies, improved methods of risk measurement and assessment, the availability of more comprehensive information about individual credit histories, and an increased ability of retail lenders to obtain funds from capital markets have led to what has been called the democratization of credit. As the pricing of credit risk has become more sophisticated and more consistent, as scale economies have reduced costs, and as funding sources have increased, lenders have been able to extend credit to households and businesses that might previously have been considered uncreditworthy. The growth of subprime mortgage lending is one indication of the extent to which access to credit has increased for all households, including those with lower incomes. In 1994, fewer than 5% of mortgage originations were in the subprime market, but by 2005, about 20% of new mortgage loans were subprime. Indeed, the expansion of subprime lending has contributed importantly to the substantial increase in the overall usage of mortgage credit. From 1995 to 2004, the share of households with mortgage debt increased 17%, and in the lowest income quintile, the share of households with mortgage debt rose 53%. Although the emergence of risk-based pricing has increased access to credit for all households, it has also raised some concerns and questions, which are magnified in the case of lower-income borrowers. For example, although subprime lending has grown substantially, are prime credit products sufficiently available, and do lenders effectively compete in all communities, including historically underserved communities? How well are lower-income borrowers matched with credit products and loan terms that fit their circumstances? Are borrowers aware of the terms and conditions of their loans, and more generally, are consumers sufficiently well informed to be wary of potentially misleading marketing tactics and to shop effectively among lenders? Some evidence, including recent Federal Reserve research on consumers holding adjustable rate mortgages, suggests that awareness could be improved, particularly among borrowers with lower incomes and education levels. This research suggests the need for greater financial literacy and increased access to financial counseling, a point to which I'll return later. The release this year and last of mortgage pricing data gathered under the Home Mortgage Development Act, Disclosure Act, HMDA, has highlighted a different but potentially related concern about access to credit on equal terms. The data show that blacks and Hispanics are considerably more likely than other borrowers to receive higher-priced loans. This finding has several possible and not mutually exclusive explanations, ranging from illegal discrimination to the effects of legitimate pricing factors not captured in the HMDA data, such as loan-to-value ratios and borrower credit history. Of course, as an agency committed to the rigorous enforcement of the fair lending laws, our job is to distinguish legitimate from illegitimate sources of pricing differentials among the banking institutions we supervise. In our enforcement efforts, we analyze the HMDA price disparities in conjunction with other information, such as the adequacy of the lender's fair lending controls and the presence of business practices that may put lenders at risk for pricing discrimination. For example, a lender might offer its loan officers financial incentives that have the effects of inducing them to charge some applicants higher interest rates or to steer them to higher-priced loan products. Lenders at risk for pricing discrimination receive targeted reviews of their pricing to ensure that they are complying with the fair lending laws. Loan price disparities, however, are not just a legal and supervisory issue. They also raise important social and policy concerns. The questions I raised earlier about access to prime products, lender competition, borrower awareness, and financial literacy may well be relevant to understanding the price disparities that we observe. Further research to explore these questions and their possible connection to disparities in lending to members of minority groups would be highly worthwhile. In fact, the Federal Reserve's upcoming Community Affairs Research Conference will feature several papers that explore these issues. The important issue of loan pricing aside, expanded access to mortgage credit has helped to fuel substantial growth in home ownership. The national rate of home ownership increased from 1995 through mid-2006, reaching nearly 69% of all households this year. All major racial and ethnic groups have made gains in home ownership, but in percentage terms, the largest increases have been made by minority households. In particular, since 1995, the home ownership rate has increased by 7% among white households, 11% among black households, and 19% among Hispanic households. However, despite the relatively more rapid growth in minority home ownership, significant differences persist. For example, the home ownership rate for blacks and Hispanics remains about two-thirds the rate of non-Hispanic whites. As for home ownership in lower income areas, the Federal Reserve's Survey of Consumer Finances indicates that from 1995 to 2004, census tracts in all income groupings experienced gains in home ownership, with rates in lower income areas growing somewhat faster than those in higher income areas. But again, important gaps remain. For example, in 2004, the rate of home ownership in lower income areas was roughly 47%, compared to 72% in middle income areas. Another area in which progress has been made, both generally and in lower income communities, is small business development. Small businesses are essential to the economic well-being and vibrancy of local communities and to the U.S. economy as a whole. The U.S. Small Business Administration estimates that small businesses account for about half of private sector output and employ more than half of private sector workers. Moreover, because small businesses sometimes become big ones, small business ownership can be a significant stepping stone for economic advancement, particularly in traditionally underserved populations. Between 1997 and 2002, the number of businesses owned by Asians, blacks, Hispanics, and women grew more than 20% for each group, more than twice the national rate of increase in all businesses. Nevertheless, small businesses face continued challenges. Each year, about 500,000 firms close, in some cases because of difficulties in obtaining credit. Interestingly, the data do not indicate that experiences in obtaining credit differ greatly across neighborhoods at different income levels. According to the Federal Reserve Survey of Small Business Finances, for example, the proportions of businesses that were either denied credit or did not apply for fear of being turned down were similar across neighborhood income groups. Many factors have contributed to the economic gains that I have cited, including broad macroeconomic forces and advances in the delivery of financial services. CDFIs have also played a valuable role by analyzing the economic potential of lower income markets and developing strategies and marshaling resources to tap that potential. As CDFI leaders, you are keenly aware of the economic challenges that you work to overcome each day. Economists find it useful to think about these challenges in the context of the economics of market failure. Standard economic analysis tells us that when competitive conditions prevail, the resulting prices in a market should induce firms and individuals to allocate resources in a manner that tends to maximize social welfare. However, economists also recognize that various deviations from idealized market conditions, termed market failures, can inhibit the efficient allocation of resources. In one type of market failure, called a neighborhood externality, the actions of one person affect the well-being or economic welfare of others in the local area, but the individual taking the action neither bears the full cost nor reaps the full benefits from those actions. Because the individual does not bear the full consequences of the actions taken, he or she may act in a way that is not in the best interest of the area or the neighborhood as a whole. For example, the failure of some owners to maintain their properties can lower the value of well-maintained properties in the same neighborhood. Ultimately, such spillover effects from neglected properties can lead to underinvestment in the whole community, potentially harming all neighborhood residents and businesses. A related type of market failure studied by economists is known as an information externality. An information externality may arise when information about economic opportunities in an area has the potential to benefit many investors, but is costly to gather. As a result, no single potential investor may find obtaining the data to be profitable. For example, on average, lower income areas have fewer owner-occupied homes and record fewer home purchase loans than higher income areas do. Lower transactions activity makes accurately gauging property values and evaluating credit risks in an area more difficult, which may inhibit the extension of credit. Alternatively, lower income people may have shorter and more irregular credit histories, making an evaluation of their individual creditworthiness more difficult and more costly. Because a potential investor who bears the cost of obtaining data about underserved neighborhoods may be able to obtain only a portion of the full economic benefits, these data may remain uncollected. One purpose of CDFIs is to help to overcome these and other market failures that inhibit local economic development. For example, by facilitating larger-scale property development projects, coordinating public and private investment efforts, and working to improve amenities and services in a local area, CDFIs may help to solve the collective action problems and reduce neighborhood externalities. CDFIs can counter information externalities by assuming the cost of learning about their local communities and developing specialized financial products and services that better fit local needs. In general, CDFIs provide coordinated development activities and community-specific information that the market would not supply on its own. Among other benefits, the familiarity with each community that CDFIs develop can help to gauge and to control risk. For example, the use by CDFIs of appraisers who specialize in evaluating properties in a particular community produces more reliable estimates of the value of the loan collateral. Likewise, CDFIs structure loans and use public and private credit enhancements both to increase borrowers' ability to qualify for loans and to spread the associated credit risk among a mix of private creditors and other providers of funds. Although these specialized techniques can reduce credit risk, they are labor-intensive and consequently expensive. Most private lending institutions reduce costs by adopting processes that are highly standardized and automated. Such systems are not necessarily compatible with lending to borrowers who require substantial screening, counseling, and monitoring, or with acquiring specialized information about community development lending. Part of the explicit mission of CDFIs is to assume the cost of conducting such research and analysis in underserved communities. CDFIs have also developed techniques and strategies such as flexible underwriting criteria, specialized loan products, and intensive financial education programs to meet the financial circumstances of their communities. Moreover, in recent years, CDFIs have been working to expand their role as information brokers beyond the local communities that they serve. Through national initiatives to collect industry-wide data and to securitize community development loan portfolios, CDFIs are working to expand access to credit and capital for lower-income markets. In short, knowledge and expertise, together with the ability to build new relationships, are the principal contributions that CDFIs bring to the market and to underserved communities. Can private market participants profit from community development lending? Data based on Community Reinvestment, or CRA Act, examinations tell us much about the volume of such loans, but less about their performance and profitability. However, a Federal Reserve study found that nearly all banks reported that their community development activities were profitable, at least to some degree. About two-thirds of the banks also reported receiving some benefit from their lending unrelated to loan profitability, such as an improved image in the community. Since the Federal Reserve report, studies undertaken by the CDFI Data Project show that for 2004, charge-off rates for CDFI portfolios were similar to those for the banking industry as a whole. These studies and market data suggest that banks and other private organizations may become an increasingly significant source of competition for CDFIs. That is good news, not bad news. Indeed, the surest sign of a CDFI's success is that private investors see viable investment opportunities in the neighborhoods in which the CDFI has been operating. Although in some sense the mission of CDFIs is to make themselves unnecessary, I expect that the knowledge and goodwill that they have accumulated in local communities will continue to make them relevant. For example, I mentioned earlier the loan pricing disadvantages faced by members of minority groups that have appeared in the HMDA data. CDFIs may be able to help reduce those discrepancies by using their local knowledge and financial expertise to offer alternatives to conventional subprime lending. The Opportunity Finance Network, for instance, will be competing with subprime lenders via a mortgage credit platform that centralizes some CDFI lending processes and directly links counseling and lending services. At the same time, CDFIs continue to expand their ability to attract private investment funds, for example, through increasing transparency and developing the means of providing objective evaluations of their financial and mission-related effectiveness. These efforts demonstrate the ability of CDFIs to adapt their business strategies to evolving markets, as indeed they have done throughout their 30-year history. I expect that the local knowledge and specialized financial expertise that CDFIs provide will continue to add significant economic value and complement market forces in the support of community economic development. Thus, CDFIs are likely to contribute to our shared goal of expanding economic opportunity for many years to come. Thank you very much, and congratulations on your good work.
Thank you, Mr. Chairman, for your thoughts and your suggestions and your ideas. For the people in this room who every day work in communities, I think it's a tremendous boost and a tremendous help to know that we're working together with the Federal Reserve, with the financial system, with foundations, with faith-based investors to try and create what we would call an inclusive prosperity based on one economy, not two. And we look forward throughout your tenure. We wish you well in your tenure for everybody's sake. But we look forward to working with you and teaching you some more about what we do in the communities. And I know there are 700 or 800 people out here who would love to have you come visit whenever you're in town. We know that working with you and the research you can do and the work that you and your staff and the Fed system across the country do for us will help us succeed, and we appreciate it. Thank you very, very much. I know that this isn't the only thing you're doing today, and you may have other things to do, so we understand that. We want to thank everyone very much for your patience. It's been a great day, and thank you.